What is going on, everyone? I hope you are all having a fantastic day. So we all know that we should be investing, but I know for a lot of people it can be extremely daunting and confusing, and you feel like you have no idea where to get started. So today I want to break down everything that you need to know about getting started with your investing journey and show you that it is a lot more simple than you might think. We're going to discuss the difference between mutual funds, index funds, ETFs, talk about expense ratios, and all of the different types of funds that you have access to, and how it positively can affect your financial future. If you get value out of this useful information, then consider hitting the like button and sharing this with a friend or family member who you feel could use this information as well. Alright, let's jump right into it. So I know that getting started with investing may seem so complicated, and while it definitely can be incredibly complex, it does not have to be, and it all starts with setting realistic expectations and goals. I'm sure if you're watching this type of YouTube video, then you've seen the ads for the day trading gurus who get 40% a day shorting options contracts, but I'm sorry, that is just not realistic, and if they were able to do that consistently, then they wouldn't be trying to sell you their overpriced course on YouTube. The truth is, the markets average 7 to 8%, and they've averaged that over the past 100 years, so a 7 to 8% return is very realistic. And when I say the markets, I mean the large indexes that you hear about on the news all the time, like the S&P 500. And remember, this is an average, so some years you might be up 20% or more, and other years you might be down 20%. But over a long period of time, you can realistically expect a 7 to 8% return per year. And I also want to mention that the S&P 500 has never once had a negative return over a 20-year period of time. So in my opinion, long-term investing is a pretty safe bet if you ask me. So now you have a realistic expectation on what to expect, but you need to ask yourself whether you want to be a passive investor or an active investor. And for 95% of people, the answer is always going to be passive. There's a few reasons I say this, but even a financial nerd like myself who loves following the news and earnings of individual companies would rather earn a passive form of income through investing. Plus, I understand that a hands-off approach to investing will almost always come out ahead over actively trading something. Of course, there are people like Warren Buffett who are able to break down every single detail of a company and pinpoint exactly which individual stocks they want to invest in, but for most people, this is just not necessary, and a broad, diversified fund is really all it takes. Now, that brings us to the next talking point, which is something that a lot of people get super confused about, and that is, what the heck is the difference between a mutual fund, an index fund, an ETF, a stock, and all of that stuff? Well, for starters, a stock is the easiest, and that's a small piece of a company or share, and when you buy a stock, you essentially own a very small piece of that company. However, this means you put all of your eggs in one basket, and because of that, it can be extremely volatile and risky. So that is often what pushes people towards mutual funds, index funds, and ETFs, which stands for Exchange Traded Fund if you didn't know. But what is the difference between these three things? Well, essentially, a mutual fund is a basket of hundreds, if not thousands, of different stocks and assets, which is actively managed by an individual or team of financial professionals who are typically those Wall Street hotshots that you see on TV making overdramatic faces when there's a volatile trading day. So a mutual fund can be focused towards a particular sector or broad market, but the managers are constantly buying and selling individual assets that they see value in an effort to beat the market. But newsflash for you, 99% of the time, they cannot beat the market over a long period of time. And that brings us to index funds and ETFs. Now, there are very small differences between index funds and ETFs, but for now, let's view these as essentially the same thing. Index funds and ETFs are very similar to a mutual fund in that they are a grouping of hundreds or thousands of stocks and assets. However, they are not typically actively traded, meaning the assets that make up a particular index fund or ETF are pretty much set in stone and very rarely change. So you might have an S&P 500 mutual fund where a manager is constantly buying and selling companies that are within the S&P 500, and they see value in those companies. But an S&P 500 index fund simply owns all 500 companies, and that's it, and it rarely buys or sells anything for the most part. Now, there's two main advantages to this, the first of which being that over long periods of time, a hands-off approach to investing almost always comes out ahead. And while there might be a hotshot Wall Street investor who gets lucky for a few years, eventually they will either lose their touch, or they'll get bored or make too much money and pass this on to a new manager who is not able to reproduce that result. So when you're looking at investing in something not for a matter of months or years, but decades, an index fund is typically always going to come out ahead. Now, the second advantage is that since an index fund or ETF is not actively managed by a highly skilled individual, individual, the expense ratio, which we'll talk more about in a second, is typically significantly lower, meaning you pay significantly less in order to own that fund. Before we talk about expense ratios, I do want to circle back quickly and explain that index funds and mutual funds both typically have a slightly higher barrier to entry, meaning a lot of times they have a minimum investment, plus they are not actively traded intraday, which means during each day, because the price is only posted once a day after trading is closed. An ETF, however, can be actively traded just like an individual stock, and the price of an ETF is constantly updated throughout the day. So in that way, index funds and ETFs are slightly different, but as far as the long-term advantages that each of these provide, they are essentially the same thing. Okay, so like I said, all of these funds come with what's called an expense ratio, and essentially this is a management fee that you pay in order to own that fund. Now, let me be clear, this does not mean that you're paying some monthly subscription or anything like that in order to own this fund, but instead this takes the form of a small percentage of how much you have invested. Now, these expense ratios can go all the way from 0% or nothing and go all the way up to well over 1% or more. To give you some perspective, my personal favorite index funds and ETFs come from a pretty well-known company called Vanguard, and their average expense ratio is 0.11%, which is pretty good considering the industry average is 0.67%. So what this means is if you had $100 invested with Vanguard, then you would pay 11 cents each year to them for managing that index fund. However, since mutual funds are actively managed, as we talked about earlier, they typically have a significantly higher expense ratio that can easily exceed 1%. So in that case, if you had $100 invested in a mutual fund with a 1% expense ratio, then you would pay $1 per year to that fund manager. Now, $1 a year doesn't sound that bad, but once you start investing a lot more money, 1% of, say, $1 million is a lot. So for that reason, I personally prefer index funds and ETFs, but I do want to say that you should never obsess over the expense ratio of a particular fund. Is it important? Absolutely, but I constantly hear people fussing over the minute differences in expense ratios and the dividend yields, but at the end of the day, you simply need to feel confident in what you are investing in and then actually invest. I talked about this a lot in Monday's video where we looked at the best ways to manage your money like the 1%, but when it comes to investing, the most important thing is that you actually take action and invest your money. So those are the main differences between mutual funds, index funds, and ETFs, and I hope that now you get a little bit of a better understanding of the different expense ratios and how they work. But even within these particular funds, you have many different options that can typically either confuse people or allow them to create a perfectly diversified portfolio, and that is what we want for you. So let's say you've decided that you want to purchase a index fund or an ETF, but you have absolutely no idea which one to buy, which is pretty common considering there are thousands and thousands of options to pick from. Well, you can narrow down your search by choosing a particular asset, a sector, or a lot of other criteria as well. For example, you can purchase an ETF that is a US bond ETF, which means it is an exchange-traded fund made up entirely of US bonds, which if you don't know, basically means you are buying US debt, and trust me, there is plenty of that to go around. Now, something like a bond ETF is typically considered a lower risk investment, but remember that something that is lower risk often has a lower average return as well. Now, I am absolutely not a financial advisor, so please do your own research and don't just take the advice of a random guy on the internet, but the general rule of thumb is that older individuals who are closer to retirement should own more of these bond assets because they are lower risk, and at an older age, you have less time to recover if there was a short-term volatile dip in the market, such as the current circumstances that we've been facing. So let's say you're close to retirement and you own really risky assets like individual stocks. Well, the current circumstances that we just faced a few months ago would have caused your account to go down significantly. And if that had stayed down for a long period of time, then you may have not had enough time to recover before retirement, meaning you would have had to work for longer. And we definitely don't want that. So bonds give you a nice amount of stability, but there are lots of other options as well. Like I said, you can buy stock ETFs, narrow that down by particular sectors like healthcare, finance, or technology, and even purchase a REIT index fund or ETF, which is a real estate investment trust. Now, personally, in my unprofessional opinion, I keep about 80% of my investments in stock-related index funds and ETFs, and that's simply because I am really young and therefore I can afford to take on a higher level of risk. But I do still have a small percentage in other sectors like real estate investment trust and bond ETFs and index funds, since that is a nice, consistent, and safe form of investment. And as I get older, I can slowly purchase more bonds and fewer stocks. Again, this is just my personal plan of attack, so definitely not something that you should be taking as personal investing advice, but be sure to do your own research and get help from from a financial professional who can help you pick out the best investments for your financial goals. So I hope this video gave you a better understanding of the different types of investments available to you, the expense ratios that come along with them, and the different ways that you can break down ETFs, index funds, and mutual funds into different sectors and other criteria. If you did get value out of this video, then it would mean a lot to me if you would consider hitting the like button and subscribing to the channel so that you can see all of the great videos that I have coming up. As always, thank you so much for your time. I seriously do appreciate it so much. Take it easy, and I'll see you in the next one.